Government bonds are amongst the oldest instruments available for investment in the country. Government is probably also the largest issuer of new capital in the country. Most of those bonds, unfortunately or fortunately, are taken up by professional investors like banks, mutual funds, institutions, etc. The retail investor is always welcome to invest in them. We need to create a greater awareness and market for them. To this end, the government has been making some effort for quite some time. Now that sophistication of investors, intermediaries has grown over the last 25 years since the advent of mutual funds and now pension funds, I think it is a good time to once again give a push to participation of retail investors in government bonds. Government bonds have one special feature, and which is the sovereign guarantee. Come what may, these bonds are always secure, because it's like if you pay tax to the government, you know it gets a credit. Similarly, your currency notes have a guarantee for redemption of value. The government securities in that sense are as good as currency notes that has the backing of the government. So I think it's a good thing for investors to consider, depending upon their needs, to look at a slice of government bonds as a part of their portfolio. So the big benefit of investing in government bonds is security. Certain bonds also have very high levels of liquidity. Normally the principle in bond market is that shorter the maturity of the bond, easier the liquidity, because everyone wants short-term paper. But in India, we don't have very long-dated bonds like 30-year bond. The 30-year bond in US is very popular. And now slowly in India, we are issuing longer-dated bonds. But the 10-year bond is a very popular bond. And the 10-year bond, depending upon its maturity, could be a 9-year bond, 7-year bond, 3-year bond, etc. The other large category of bonds is what is called the Treasury Bill. And there again, you have a 90-day bill or a longer-dated Treasury Bill, which normally again gets taken up by banks, etc., who want to manage their liquidity in a secure manner. But in both the categories, retail participation is welcome and possible. The investors must understand that the value of a bond remains constant, but the price of a bond can vary depending upon what the current interest rates are. So when interest rates go up, the price of a bond will fall and vice versa. With that understanding and the general understanding that over the last 5 years, we have seen interest rates go down, and the trend seems to be interest rates going down, then the old bonds, they tend to get marginal appreciation in proportion to the fall in the yield or the fall in interest rates. So that's how one has to understand the bond market. So the government bonds hitherto have been accepted, have been invested into by the institutional players, and so the money market brokers typically market all these to these institutions. For the investors, I think it will be a good thing to go and visit the stock exchange sites or the treasury site, which is the RBI or the discount house finance or the government itself, and then see what are the intermediaries available who are selling these bonds or making these bonds available to them. So I think just taking some interest in it, some initiative in it will be a good thing. Stock exchanges, websites are the best place to start.